October was a very poor month for equities, with volatility and negativity suddenly hitting the markets. But economic data remains sound, so how do we reconcile these price movements? US stock market indices lost around 12% from peak to trough last month, before a late recovery in the last few days of October, which was similar price action to earlier this year in February. That episode was followed by a messy recovery, but ultimately new highs by August. So it remains to be seen if this sell-off is just another correction in this record-long bull market, which started almost a decade ago, or the end of the upswing. As we've noted regularly in our updates this year, it all appears very late in the cycle, and so remains a risky period for global assets. But picking tops is of course impossible. What we can measure, however, is how expensive assets have become, which is exaggerated by low interest rates. And so prices are very sensitive to increases in bond yields, which have shot up in the last 2 months. Price to earnings ratios are the most widely used measure of relative expense for stock markets. And as the chart shows, Australia is less expensive than the global PE ratio average, and certainly cheaper than the US. So it's no great surprise to see US stocks correct lower, especially as trade tariffs hit their import costs. But our market also fell last month, around 6%. For Australia, the financials component of the ASX 200 has been a drag on the index. But unlike the US, we aren't facing higher interest rates. So the weakness can also be attributed to uncertainty about China. The Chinese currency, the yuan, has been falling in US dollar value, as the chart shows, well correlated to the weaker Aussie dollar. And a weaker currency there, plus more Chinese fiscal stimulus, should help China, our largest trading partner. But their stock market is down 25% this year, so US trade policy hasn't helped. Back home, the other market that's under pressure is housing, which is getting plenty of negative airplay in the media. But we're not alone in house prices declining, and as the RBA has pointed out, the falls are most evident in investor-related property, while owner-occupier lending is still growing 7% year on year. Like the stock market, these declines look like they have further to go, but it's always useful to look at the long-term performance of assets and to remember that prices don't always go up. Australia's inflation data came in just below target at 1.9% for the CPI and 1.75% for core inflation. So no RBA rate rises on the horizon here, which is one less thing to worry about. November will probably remain volatile in the markets, but the main data this month will be jobs figures out on November the 15th, where we expect the trend of job creation to continue. So economically, the outlook remains solid, but some asset values are likely to continue to be challenged as bond rates move higher, correcting overinflated values. And that's the market update from Bendigo Bank.